Welcome to the Commercial Real Estate Show. I'm Michael Ball. This is your source for market intelligence, forecasts, and strategies. Thanks for being with us. Maybe you're listening on one of the radio stations around the country. Maybe you're on iTunes, YouTube, or the show website, commercialrealestateshow.com. Well, today we have a great show for you. We're going to look at the Fed's view on commercial real estate. And we have Brian Bailey here. He's the senior technical expert with the Federal Reserve Bank of Atlanta in Studio One with us. Brian, thanks for being with us again.
It's great to be back, Michael. Thank you for having me.
And Brian, I think one of the things that people might be curious about when they think about the Fed and the Fed's role and policy, why do they have a real estate expert? What do you do there?
Well, obviously, these are my views and not necessarily those of my esteemed colleagues at the Federal Reserve Bank of Atlanta or the Board of Governors. But certainly, commercial real estate makes up a significant amount of the economy, and certainly one of our charges is the safety and soundness of the financial system. And so certainly we know that the banks are engaged in commercial real estate lending, and as part of the safety and soundness operations, we're looking at how those loans are done, what the underwriting looks like to make sure that the safety and soundness of the financial system is ensured.
Okay, so you're looking at the commercial real estate world and kind of helping the Fed look at what's happening out there? You bet.
I mean, we look at appraisals, we're doing analytical work, trying to understand at what point the markets are in the cycle, trying to gauge, risk and trying to be out in front of, the next potential downturn.
Yeah, well, that's good. So how big is commercial real estate in the U.S. economy?
So there's about 1.6 trillion in commercial real estate loans at the banks right now. It represents, by the time you add in the spend on infrastructure, new construction, the salaries associated with the gambit, real estate probably accounts for roughly 6 to 7% of the gross domestic product of the economy.
That's pretty big. I mean, does that surprise people when they hear that?
It sounds like a small piece. I mean, 6 to 7%. Yet it's probably it is a huge magnitude.
Yeah.
Huge. Yeah.
Yeah, it really is. And one of the things I think that people have been really reeling with in the commercial real estate world are kind of the new regulations, like the DoddFrank regulation. So how is that working right now with the banks and other lenders? How's it coming along?
Well, Dodd-Frank certainly has, the way I like to talk about it as far as Dodd-Frank and commercial real estate, certainly has caused the banks to really heighten their game in commercial real estate. They've got to understand, the risks and the nuances around the property types much better. Certainly I think that with more regulation, there are more associated compliance costs. And so I think that, the institutions are working to look at that risk, which is then, kind of mitigating the potential downside of a 2008 or 2009 event. So certainly I think it's good for the financial system. It's also come into play in CMBS. And CMBS certainly has gone through a lot of volatility. The volume is way off this year, but 2 days ago, Wells Fargo, Bank of America, and Morgan Stanley, were able to price, the first risk retention compliant issuance. Roughly $870 million. The loans obviously were squeaky clean, as you can imagine when something with that's changed a little bit is coming out, but very well received. The spreads were compressed compared to where the market thought they would, so it was very well received. And so certainly I think it's a good time to begin to see a little bit of the reboot per se with these risk risk retention compliant issuances, because there certainly are, a significant amount of CMBS loans associated with the '06 and '07 loans that were made back then that need to be refinanced over the next 12 months or so.
Yeah, we need the funds available out there.
Absolutely.
So might we expect CMBS to have an uptick in the volume?
I mean, your guess is as good as mine, but certainly it was the first issuance was very well received. And so, my hope is that we do see, more issuance in that area, because certainly, it is a source, a needed source for financing, whether it's new financing or refinancing. And certainly that kind of goes to some degree along with what the banks are doing. And so, we're continuing to watch that, because with $10 to $15 billion a month in CMBS loans that are coming due each month through June of next year, that's a lot for one source to handle. Certainly banks could do it, but certainly it's a lot for one source. And so certainly I think the more sources that we have, that are disciplined with the underwriting, certainly I think that's good news to see another source getting back into the game.
And of those loans that are maturing, that are 10 years old, that were done at the top of the market, how many of those might have some issues and have to require more capital to be refinanced?
Well, and it's a good question. We've done some analytics kind of looking at, the CMBS loans from 2006 and 2007 specifically, and trying to understand, what the delinquencies look like right now. And the number's surprising. First, let me talk about delinquency. How is it delinquent? Well, it's delinquent because maybe the borrower just woke up and their loan has matured and they didn't get new financing in place, but the property is fairly healthy. So it's probably a pretty easy fixed remedied solution. So that's one tranche.
A maturity default.
Maturity default, basically. The second is it has some kind of hair on it. For instance, it's a retenanting or a CapEx issue. A little bit more complex. It may take a little bit more time to kind of work out. And then third is just property that probably should not have been built in 2006 or 2007 because of changes in the marketplace that have occurred in the last 10 years. So we see markets where the delinquencies range from a few percent upwards to 40 or 50%. And again, we've turned the dial all the way up. So we're looking at the markets with one loan of $5 million that's delinquent, and so that market would be considered 100% delinquent, all the way to New York City, where there's several trillions of dollars of loans that are coming due. But you take Atlanta right now, the delinquencies are in the double digits, kind of mid to upper teens. You take Jacksonville, Florida.
Of all the loans, or of the loans maturing?
Of the loans maturing in 2016 and 2017. So I'm just looking at that tranche, that group. You take Philadelphia. It's kind of on a similar trajectory. I think to Atlanta, there's probably $600 million that are delinquent right now. You look at Jacksonville, Florida, the numbers, 30% of the loans are delinquent. So certainly they can be cured. Some of them can come out pretty easily. Some of them can't. But there are some areas of the country, we've mapped 382 markets. And so we're looking at a very granular level. Obviously, I think that has implications for some of the bank lending. In some of those areas, and so we're talking about it, trying to make some of the financial institutions. Obviously, our focus is the safety and soundness of the financial system. So we figure we bring it up and talk about it. Certainly, it makes banks aware of those issues in some of those markets.
And what about property types, Brian? As far as those loans that may have some issues coming up for maturity, what type of property types are the worst culprits?
Right. I mean, the two that stand out in my mind are retail and suburban office. They had, the pretty significant value decline. We were doing more construction and more lending of those property types back in '06 and '07. And so certainly, those two sectors are kind of piquing my curiosity. If you look at kind of prices in the non-major markets, the prices for those two property types have not returned to their 2007 peaks, so adding more pressure. In addition to, the industry was fairly liberal with some of the terms back then.
Yeah. Well, that's interesting to talk about those two sectors and property types because as a broker here in Atlanta and doing deals in the Southeast, that's what we get the most people looking for. Hey, give us some of the suburban office that have some of the value add opportunities. Let me look at some of the retail. So there's a lot of buyers and a lot of capital out there looking.
Right. And you look at, those two areas, those two property types, probably, arguably, the two property types that have been most impacted by disruptors.
Yeah, and some of those buildings are old, and so you got a challenge there.
Right.
Well, stay with us, take a short break. We'll have more from Brian Bailey with the Fed. This is the Commercial Real Estate Show. Hey there, thanks for checking out the Commercial Real Estate Show. Don't miss a video of special interest to you. Be sure to subscribe below. And if you appreciate the videos, be sure and thank our sponsors. There's a link to more information about them in the description. For more videos, podcasts, and articles, check out CREshow.com.